Hello ladies and gentlemen, if you're watching this it means you've decided to get to know a little more about Forex trading. Welcome.
The currency market is only one part of a huge world of exchange where everything is a commodity, from wheat to diamonds. It's a world of hopes and disappointments, a world of passion and cold calculation. Untold wealth is made here. This is a world of strong, decisive people, people who do not look at life through rose-tinted spectacles. There is no place for illusions here, though, paradoxically, what are traded on the exchanges are as intangible. We deal in beliefs and expectations. But wait, I'm getting ahead of myself. Let's take things one step at a time.
Foreign exchange trading. Let's consider the main thrust of this phrase, exchange trading. How did it appear? What is the modern exchange? And what is traded here?
The modern stock exchange is the highest form in the long evolution of global trade. Merchants and traders gradually developed from working in caravans and noisy bazaars to organizations like stock exchanges. In the Middle Ages, merchants only met at a certain place once a year, at fairs or markets. But nation-states and new trade routes were being developed. New continents were being discovered and new goods were appearing on the market. Cities and populations prospered with this boom in trade. In large seaports, like Antwerp, trading began to take place on a daily basis. Initially in the open air, and then, later, in buildings specifically designed for this purpose. One of the first European stock exchanges opened in Antwerp in 1531. Over the years, a set of rules governing exchange trading grew up, and in the most developed economic nations, these rules are enshrined in law. Modern stock exchanges are a major element of the global economy.
Liquidity, absolutely vital. This is the most important property of an exchange commodity.
It means that the commodities can be bought and sold freely. Only liquid commodities are allowed on the exchange platform.
The second property of exchange commodities is a precise rating of quality.
For example, gold bars must be at least 99.5% pure gold. Petroleum is divided into certain grades, the highest grade being Brent.
The third property of an exchange commodity is an agreed minimum quantity which can be traded on the exchange platform. This amount is known as a lot.
For precious metals, a lot is measured in troy ounces, each equaling 31.1035 grams. On the Chicago Gold Exchange, the minimum gold lot is 100 ounces. Petroleum is measured in barrels, and on the London Petroleum Exchange, one futures contract is equal to 1,000 barrels.
Well, and what are currencies measured in?
At the London Financial Futures Stock Exchange, one lot is equal to 1 million American dollars.
The fourth integral property of exchange commodities is a fluctuating price which responds to supply and demand.
These levels of supply and demand vary as news reaches the exchange platform from the outside world.
We've already given examples of things that can be traded. Commodities like gold, or petrol, or currencies, and of course there are things like shares and bonds. We're going to divide these things into three groups, depending on which exchange trades on them.
The first group is the commodity exchanges. These were the first exchanges and evolved from the quayside and markets. Nowadays, however, they do not trade in real goods anymore, but in obligations to buy or to sell certain amounts of goods at a certain period of time. These obligations are in the form of future contracts, forward contracts and options. To cut a long story short, this is a trade in expectations.
Without these expectations, it would be impossible to carry out real long-term contracts. Modern life would be impossible without the commodity exchange.
The second group of exchanges deals on the stock market. Here we have a trade in paper. Not just any paper, of course, but financial paper, such as securities, contracts, bonds, and other complex financial tools. Modern stock markets are an economic thermometer measuring the temperature of the global economy.
The third group is the currency exchanges, the group we're most interested in. Currency is traded on them. One nation's money is exchanged for another's. Today, we shall explore exactly how these transactions are carried out. But before rushing into this business headlong and learning how to make Forex currency deals, we need to understand something about the global currency system.
World War II not only changed the political balance of power, it also left both Europe and Japan in ruins. In 1944, financial representatives of the Allies met in Bretton Woods, a small town in the USA. They discussed the problem of a post-war financial mechanism for the restoration of the global economy. To this end, the International Monetary Fund was founded. America agreed to peg the value of the dollar to gold. 1 troy ounce of gold was equal to $35 and the other members' nations' currencies were pegged in turn to the dollar.
The dollar had taken the baton from the British pound, which had predominated international payments since the middle of the 19th century.
By the early 70s, the global economy was on the upturn. Germany and Japan, the defeated nations in the war, had developed into economic powerhouses. The dollar had ceased its gold parity for some time, and it was decided to temporarily suspend the Bretton Woods Agreement.
In life, nothing is as constant as the temporary, and by 1978, a floating currency system had been established.
Even so, today's prices for metals, petroleum and international debts are still in American dollars, because for the first 30 years after the war, there was simply no alternative. There is no doubt that the US dollar has enjoyed its precedence as the present global reserve because the US is the world's largest economy, and because of the key role the Bretton Woods Agreement played in post-war reconstruction. But the times are a-changing, and there are challenges to the greenback's preeminence. In 1999, 12 European countries, including Germany, France, Italy and Holland, relinquished their own national currencies and created the new single European currency, the euro. This is, without doubt, an attempt to create an alternative global monetary unit.
And then there's China, with its enormous markets and industrial vigour, flexing its economic muscles. It could well be that the word yuan will be heard more and more frequently on the world's currency markets. In the Islamic world, the gold dinar has been under discussion for over a decade, so we shall see what we shall see. It's possible to buy and sell money for money, just like any other commodity.
The payment for money is the interest rate which the seller receives. At a basic level, when you put money into your bank account, the bank is the buyer and you are the seller. The bank pays you interest for the use of your money. The money markets have been set up to trade in money. The participants of this market give or take money for a period of time at an interest rate. The companies, the banks and the state buy and sell money in the form of certificates of deposit, bills and bonds. These operations are made in the national currency.
And after the introduction of floating currency rates, national currencies began to go on sale for foreign money. That is to say that money had become a commodity, an exchange commodity.
Remember, one of the main properties of an exchange commodity is a way of gauging quality. The quality of a currency is measured by how far the national economy has developed and by the issuing state's ability to meet its financial obligations. Today, almost all international transactions are carried out in 5 currencies. In prime position, the American dollar. In second place, the European currency unit, the euro. Next, the British pound, sometimes known as pound sterling. And then, the Japanese yen. Finally, we have the Swiss franc. Somebody once called it the safe refuge currency, since secret bank accounts are enshrined in the Swiss constitution. And for many wealthy people in today's world, this factor is, for some reason, immeasurably attractive. Forex, foreign exchange. It means the foreign currency exchange. Foreign currency is brought to other countries by tourists, businessmen, travellers, pilgrims. There are ships out at sea carrying every possible cargo, and money flows around the world in exchange for these goods. The need for foreign currency constantly arises in people and companies in different countries. 365 days a year, 7 days a week, 24 hours a day, without lunch breaks and days off. Who works on the currency markets? First of all, there are the central banks of countries. They endeavour to maintain a currency rate to optimise their economic management. Then there are commercial banks. They aim to manage their customers' funds and preserve their own liquid assets. Financial companies and brokerage houses represent the next group of players. They set out to make money by dint of financial asset management and working as an intermediary. Well, last but not least, there's the private individual, people like you and me. The collective actions of private individuals underpin the financial policy of the higher levels in this hierarchy.
The original currency trade was set up in national currency exchanges scattered around the globe. Business news services like Dow Jones, Bloomberg, Reuters and others collect currency quotations and sell them on to banks, investment companies and brokerage companies like Forex Club, for example.
Although on each separate exchange the trade session lasts from approximately 10 o'clock until 6 p.m. local time, these sessions overlap each other like a relay race. Let's look at the setup.
So, currency trading can be carried out throughout the 24-hour period without lunch breaks, but, to tell you the truth, with days off. During these days off, the stock exchange takes a break too, and when this happens, banks carry out foreign exchange transactions directly with each other when necessary.
Time on the currency market is Greenwich Mean Time, or GMT. The Greenwich Meridian runs through Greenwich, a London borough. It's generally accepted that the end of the trading day is at 21:30 GMT.
Now, I've got some good news and some bad news. The good news is that when the financial markets are closed in Western Europe and the United States, you can have a holiday, put your feet up, take a break from the exchange. The bad news is that you will find yourself working through local holidays.
Earlier, when international trade used gold and silver coins, the national origin of these coins was not important. The weight of the coins and the hallmark were important. gold has no nationality. It's welcome in every home and everyone accepts its value. When paper money began to be used, it was necessary to calculate its relative worth, so the expression of one unit of foreign currency in the terms of national currency is a currency quotation.
In the modern world, it's accepted that the value of the main currencies is measured in US dollars. So, taking the 5 currencies we mentioned earlier, we have 4 pairs. Here they are.
Swiss franc, Japanese yen, British pound, the euro.
And let's take a closer look at these pairs.
In a currency pair, the first currency is the currency we can buy and sell, and the second currency is the currency we buy and sell it with. Taking the quotation USD CHF, this means that today it's necessary to pay 1 Swiss franc 24 centimes for 1 American dollar. Similarly, this quote, USD JPY, tells us that today in Japan they'll give you 112 yen for 1 American dollar. The first currency in a currency pair is the base currency. For the yen, the Swiss franc, and the majority of other currencies in the world, the US dollar is the base currency.
And are there any currency pairs where the US dollar is not the base currency? Yes. Whose idea was that? Why make life more complicated than it needs to be? I can only say 2 little words: tradition and ambition.
At the time when the concept of currency pairs was being developed, the British Empire was the dominant economic power. The British pound is the oldest currency in the world. In fact, it will soon be celebrating its 1000th birthday. For most of the pound's life, until the early 1970s, the pound was made up of 240 pence. How could we show the value of $1 in terms of GBP? For example, if $1 was worth 60 British pence, we'd have to write it as 0.25 and not 0.6, and this could cause a great deal of confusion. Therefore, it was decided that it would be much easier to state how much a pound was worth in other currencies and not be tormented by all those pesky pennies, farthings and shillings. So, the pound is the base currency in the pair GBP USD.
And though the British pound has had 100 pence since the 1970s, and Britain no longer has a great empire, the tradition remains, my friends. And so, this pair tells us that today, 1 British pound will cost you $1.82.
However, when the Europeans were introducing their single currency, they quite consciously decided not to be bettered by the world's oldest currency and insisted on the euro being the base currency.
There was no need. The metric system was laid out in Europe a very long time ago. This was simply naked ambition, ladies and gentlemen.
And the pair Euro-USD appeared, with the euro proudly assuming the base currency place. And the quote Euro-USD means that today a euro will cost you $1.24. You should commit these pairs to memory. Dollar Swiss franc, dollar Japanese yen, British pound dollar, euro dollar, because usually these pairs are denoted Swiss franc, Japanese yen, British pound, euro, as the dollar is taken as read and is not mentioned. Now I'd like to explain why there are so many zeros in each currency quotation after the point. In these 3 currency pairs, dollar Swiss franc, British pound dollar, euro dollar, there are 4 decimal places. 1/10,000th of a price is known as a point or pip. And if you notice that the Swiss franc has gone up from 1.24 to 1.2401, you can say the Swiss franc has risen 1 point. The price of the yen looks different. At the end of World War II, $1 got you 350 Japanese yen. The Japanese didn't bother to break yen down into 100 smaller units, as it didn't seem worthwhile. When the currencies were floated in the 70s, the yen shot up. The Japanese economy continued to perform well, and in 1995, $1 was worth only 79 yen. So, although we are familiar with the dollars and cents, francs and centimes, pounds and pence system, with the Japanese there is only yen, and its price is always written so, USD JPY.
So there you have it. A point or a pip is the smallest possible change in price. Just how much is a point worth? The reason why it's important to understand the base currency is that all transactions on a pair are done through the base currency, and all profit is paid out in US dollars only.
Let's take the Swiss franc. Remember its pair, USD, CHF. The dollar is the base currency. The minimum lot with Forex Club International is 10,000 of the base currency, American dollars in this case, and we can buy or sell US dollars only.
This concept, I know from my experience, is not always clear for beginners. You see, we're thinking about Swiss francs, but we can only work in US dollars.
The dollar plays the role of the commodity in this case, and the Swiss franc the role of money. So our aim is to buy the dollar for fewer francs and to sell it for more. The quotation on USD CHF is 1.24. One minimum lot of $10,000 will cost us 12,400 Swiss francs. Let's buy this lot. Then the price changes by 1 point to 1.2401. $10,000 at the new price now costs 12,401 Swiss francs. We've made some money, 1 Swiss franc. Every little helps, but we can only take our profit in American dollars. If we divide 1 by 1.2401, we get 80.6 cents. This is the cost of 1 Swiss franc point. If you were working with 2 lots, you would have to multiply this number by 2.
And for those of you who can't be bothered to use a calculator, there's always Forex Club software ID system. It does all the necessary at a click of the mouse. You will know exactly where you stand.
Let's move on to the yen. US dollar, Japanese yen. The dollar is the base currency here too. Supposing we buy 10,000 US dollars with yen at 110.20, so we pay 1,102,000 yen. The price changes by 1 point and is now 110.21. On selling our dollars, we receive 1,102,100 yen. Our profit is 100 yen. If we convert it to dollars at the rate of 110.21, we get 91 cents. And now, what about the euro? As the pair is Euro-USD, the euro is the base currency, and all transactions are done through the euro. It is the goods and the dollar is the money. The minimum lot is equal to 10,000 euro, and the Euro-USD quotation now stands at 1.24. We buy 1 lot at the given price, and it costs us $12,400. Once again, we sell it at the price of 1.2401. We're in luck. We've earned 1 whole dollar in this trade. We're in the money. And there's no need to divide or multiply anything. We take our profit in dollars only, and we have received our profit also in dollars. when the US dollar is not the base currency in a pair, with a lot of 10,000, the price of a point is always $1, and if you're working with 10 lots, just multiply your profit by 10.
That dear old chap, pound sterling, pays out in US dollars, just like his continental friend, the euro. So there you have it. All you need to know about the price of a point. Now you know how much 1 point costs. It's possible to tell you about margin. This is down to leverage.
Forex Club International offers leverage at 100 to 1. So, with a $200 deposit, you have a purchasing power of $20,000. How does the system work? Let's suppose that a trader has bought one minimum lot of euro and his account is very small, just $200. Unfortunately, price goes against him to the tune of 200 points. The loss is $200. In this case, the account will be closed, whether the trader likes it or not.
If you receive a profit, it's all yours, but the losses are yours too. There's no such thing as a free lunch. You've got to limit your risks and protect yourself by placing orders. More about this later, but remember, you are in control. The most important thing for you to remember once and for all is when to buy and sell foreign currency, irrespective of what the currency pair is.
In the future, you'll be working using currency charts. It's all very simple. The base currency price is drawn on the vertical axis and time is on the horizontal. The chart plots the price of the base currency. If the price on the diagram goes upwards, it means the base currency is rising in price and the currency it is paired with is getting cheaper. Let's take an example, US dollar against the Swiss franc. Very frequently the price on the vertical is designated simply by CHF. As you now know, this means that the currency pair is USD, Swiss franc, and that the dollar is the base currency. If the chart is going upwards, it means the dollar is rising in price and the franc is getting cheaper. The dollar as the base currency is the goods. If the diagram is going upwards, the goods are rising in price. It's wise to buy dollars. If it's going downwards, the price of dollars is falling, so we sell dollars. It's the same story with the Japanese yen. Going up, we buy dollars. Going down, we sell dollars.
And in a pair where the dollar is not the base currency, for example, euro,
what then? What has changed? Only the base currency. Now it's the euro. In a nutshell, it means that now the euro is the goods. When the chart goes upwards, we buy euro. Down, we sell euro. That's all. Just remember, once and for all, that we should follow the price on the diagram, irrespective of what the currency pair is. The diagram upwards, it's a purchase. Diagram downwards, it's a sale. Buy when the chart is going up, sell when the chart's going down.
Very frequently I'm asked this question. If I'm not on the market, but I want to sell euro, my account's in dollars. Where should I get the euro from?
The answer is very simple. Do not bother your head with it. Let that be the business of banking managers and Forex Club International. Your business is to correctly identify the direction of the market, upwards or downwards, and that's it. Internet trading terminals are becoming increasingly popular for making deals. Internet trading terminals are specially designed software for personal computers. Usually, Each broker or bank provides a trading terminal. As you already know, Forex Club International's trading terminal is called ID System. This is an original program.
ID System is very convenient to use, simple and intuitively comprehensible. Forex Club's developers have made every operation extremely easy. It enables you to do everything necessary for Forex trading.
All fluctuations of exchange rates are displayed instantly and without delay. There are also tick charts on the trading terminal, allowing you to track recent price changes. Dow Jones Business News and Money News is fed live and direct to the terminal. A full record of your transactions is made automatically. You can find the cost of a point by a simple click of the mouse. All you need is access to the internet. You've already seen two figures headed bid and ask for each currency pair on ID System. What do these figures and words mean? Let me explain. Any bank on the currency market acts as both a seller and a buyer simultaneously. The bank is ready to sell or buy any currency from you, but it will buy cheap and sell more expensively.
Think about the signs in a bureau de change, and you will see that they're ready to buy dollars or whatever from you, but always at a cheaper price than they sell. That is the market, my friends.
The price the bank buys at is the bid price, and the ask is the price it sells at. Bid is always less than ask. Nobody in this world will trade at a loss to themselves. The banks aren't playing the market, they are just earning money on this difference. The difference between the bid and ask prices is referred to as the spread. On the open market, where many banks are in competition, each bank wants to attract custom. In order to do this, large banks narrow the spread down to 1 or 2 points whenever possible. During the night, when market participants are few in number, the spread widens to up to 10 points.
And if there are any crises in the world, for example, September the 11th, 2001, the banks widen their spread to 100 or 200 points.
This is called risk management. These spreads are called protective. Any transactions that the bank involves itself in at such moments are extremely risky, and this risk is shifted to the client without delay. Forex Club International, which specialises in serving the smaller investor, provides a fixed spread of 5 points at any time, day or night, so you know exactly where you stand.
We're now getting to the heart of the matter, how to make a deal. Let's make a deal using ID System. It's simplicity itself. In times past, such business could only be done on the trading floor. When the telephone was invented, it rapidly became the primary trading tool. Now, with the advent of the internet, we can trade through it.
First, we decide which currency pair we want to work with. We choose the euro. Then we decide how big our lot should be. A lot size 1.0 is 1 million euro. We want to be less ambitious. If we wanted to trade 10,000 euro, the lot size would be 0.01. We want to work with 100,000 euro, so our lot size is 0.1.
Now we need to know the currency rate, so we click Request Price.
Answering our inquiry, the broker sends us two prices, a price we can buy at, the ask price, and the price we can sell at, the bid price. The broker's answer: sell 1.2244, buy 1.2249. We can buy euros at 1.2249 and sell euros at 1.2244.
At this moment in time, the broker has no idea about what we are going to do.
We give the order to sell. The broker confirms the purchase of €100,000 for dollars at the 1.2244 price, and that's it. The deal is done. It's simply a matter of a few clicks of the mouse and a minute of time with the help of Forex Club International's Trade Terminal ID system. The professionals would now say that we have an open position, but there's more.
If we have an open position, it's necessary at some point to close it. Never forget, profit or loss is only fixed after closing the deal.
We close a position in a very similar way to opening one, but if the opening position was sell, to close it we buy, and vice versa. This is what it looks like, and there you have it.
We've made a profit. Let all your future trades end like this.
By the way, for your information, when you open a position using the buy command, we say you are long, and when you sell, you are short. Why? These terms come to us from the commodities markets. As a rule, the price for the goods grows very slowly, over a long period of time, and falls very quickly, over a short time.
And from this come the terms prices going up, go long, prices going down, go short. More tradition, ladies and gentlemen. It's very simple to calculate the income from your deal. All you need to know are the number of points you've earned or lost.
When US dollars are not the base currency, a point equals $1 for every lot of 10,000. So if you've bought 50,000, it's $5 a point. Have a look at this example. You have bought €100,000 at a price of 1.24 and sold at a price of 1.2450. You've earned 50 points. Multiply this by 10. You've made $500 on the day. When the dollar is the base currency, it's slightly more complicated because the cost of a point floats. Here is an example. You bought 20,000 Swiss franc at 1.24 and then sold at 1.2450. The selling price is higher than the buying price, and that means that you have made 50 points. We calculate the cost of 1 point at the closing price of the trade, 1.2450. Divide 1 by 1.2450 and we get $0.8032 for each point. The total is $80.32. That's your earnings.
Now that buying and selling are clear and we know how to open a position, we need to move on to discuss the most important and useful tool in a trader's toolkit, the order.
What is an order? It's a command to the broker to carry out a currency transaction when the price of a specific currency reaches or falls to a prescribed level. Now, for example, the euro is at 1.24. We reckon that when it reaches 1.224, there'll be a sharp rise in price, and we're ready to buy at this price. We give the broker an order to buy €100,000 against dollar at the price of 1.2240. That's all there is to it. The first advantage of such an approach is that we do not have to follow the market. We can go off and relax. The second is that the deal will be made at exactly the specified price.
Any psychological distractions, like fear or indecision, are definitely eliminated. There's nothing further to do technically either. The order has been placed and will remain active unless cancelled. Of course, it's perfectly possible to close a position as well as to open one with an order.
The most important closing order is a protective one known as the stop loss. This order limits the amount of money we can lose on a position, as it closes the position when price has moved against us to a preset level. In this way we manage our risk by deciding in advance how much we are prepared to lose. A stop loss is usually placed with a take profit order, and this order closes a position when a certain level of profit is reached. When the order has been placed, it is designated active. As soon as it has been carried out, it is designated done. And this is how they are recorded automatically in your trading reports by ID system. Ideally, we should place stop loss and take profit orders simultaneously. But if one of these orders has worked, it's necessary to remove the second.
Otherwise, it will open a position which we do not want, and this could cost us. To avoid this inconvenience, click One Order Cancels the Other in ID System.
One cancels other order, or OCO, is an order which cancels itself out. What I mean is, if the stop loss has been carried out, the take profit order is cancelled, and vice versa. The execution of one order automatically cancels the other. What could be simpler?
And that's that. What should we do if we want to open a position using an order and we want to preset our stop loss and take profit orders, and we want the broker to do this himself without our participation?
ID System provides if done orders for this circumstance. Click If Done Orders at the bottom of the window. You will then be able to set your stop loss and take profit, which will only become active when the opening order is executed. The whole thing is set up by simply clicking Place. When this composite order has been set, the opening order is active and the If Done order is standing by. Later, when the opening order has been done, the If Done order will become active, and when price reaches the pre-designated level, this order will either be carried out as a stop loss or a take profit.
We've already clarified that on the market, money can be a commodity. Now there are a couple of things that I want to tell you about. A spot transaction is a deal that is settled at once.
The term spot originates in history when the account was settled at the scene of the trade, on the spot, and the delivery of the bought goods took a few working days. On the currency market, the majority of spot deals entail the delivery of financial tools in 2 working days.
A second concept, the swap operation, is probably more relevant to our interests. Swap is the responsibility of the broker. You need not do anything.
This operation is carried out only in the event that an open position remains open until the next day. Through swap, at 21 GMT, all open positions close at the current market price and reopen again immediately. But the most interesting thing is that when this happens, either we pay them or they pay us.
That's right. We can get paid for merely holding an open position. It all depends on which currency we've bought or sold.
Interest rates lie at the heart of this phenomenon. The central banks give credit to commercial banks at a certain level of interest. This is known as the discount rate, The important thing is that for different countries this rate is different too. In the USA it is currently 3%, and in Great Britain it's 4.75%. The difference of the interest rates is 1.75%.
For the bank, it's more favourable to buy pounds. If we buy pounds, the interest rate favours us. And conversely, if we go long in dollars, we have to pay for the privilege.
This payment is rather small, ranging from 0.1 to 1.5 points per calendar day on average. However, if an open position is held for a long period of time, the resulting sum could be significant.
All this time, we've been speaking about exchange rates involving the US dollar. But what should we do if we want to buy pounds, perhaps for yen?
There's no problem. We can get our broker to give us a quotation on the British pound against the yen through our trade terminal or on the phone, and then we could make a deal. Pairs like this are called cross rates. There's no dollar in them. There are many such pairs: Swiss franc, Japanese yen, euro, British pound, euro, Japanese yen, euro, Swiss franc, and so on, as many as there are possible combinations.
The fact is, there are no direct quotations for such currency pairs. They are all carried out through the dollar. The dollar is an invisible indicator presence.
For example, to determine the cross rate of euro against yen, the following is done. We buy dollars for yen at the dollar Japanese yen rate, and then, with the dollars, we buy euro at the euro dollar rate. Can you see what happens? In the first pair, the dollar is the numerator, and in the second one, the denominator. Using the rules of arithmetic, we can reduce US dollar, and as a result we receive the euro-Japanese yen cross rate. This operation takes place automatically and instantaneously. We don't notice it at all. Some cross rates are directly quoted. For example, Euro-British pound is quoted on the Chicago Currency Exchange, and the price there is determined not by agreement but in the usual way of the market, through demand. But the volumes for Euro Great British Pound are hardly significant.
You've certainly come across the words broker and trader before, but now you're getting into the Forex business, it's important to fully understand these concepts.
A trader is an individual or an organisation which takes decisions to buy or to sell in self-interest. And a broker or a brokerage organisation carries out trades on behalf of someone else. The broker receives a commission, and the trader makes a profit. He buys low and sells high. So today we've discussed what a currency quotation is and how much 1 point costs. We've also learned when and how to buy and to sell currency, either by placing orders or trading directly on the market. I've shown how simple it is to do this with ID System, Forex Club International's trading terminal.
And now we merely have to get down to the nitty-gritty, when and what to buy or sell. To answer this central question, traders have developed a whole science, technical analysis, and that is the subject of our next film.